Occupying the headlines for the first half of 2019 have been a dramatic mix of positive and negative news. Into the second half of 2019, we believe the investment landscape will turn more complex as more risk comes into play. So in this video, we would like to highlight the various opportunities, risks, as well as the trends across the different markets and how investors should position the asset classes in their portfolios. Firstly, we are witnessing a dovish pivot from the global central banks from the developed as well as the emerging markets. Global monetary policy stance have shifted dramatically since the first half of 2019, and this is largely due to the escalation of the trade dispute, softening of global growth, as well as tepid inflation, which created the conditions for many markets to cut rates. We believe a more accommodative stance from central banks will likely support economic growth and in return the equity markets. However, the impact might come with a policy lag of around 2 to 3 quarters. Secondly, we see continuing downside risks to earnings from the ongoing US-Sino trade dispute. Looking ahead, we believe that the tensions underlying the US-Sino trade relations are long-term in nature and would be an ongoing risk to assess, particularly for the economic as well as earnings growth. However, we know that the impending cyclical upswing of the semiconductor sector, which many Asian economies are heavily exposed to, can provide a lift for the economic activities amid the trade dispute. Thirdly, we see global growth moderating in the near term before recovering, and we believe a combination of factors such as the accommodative monetary stance, greater fiscal stimulus, as well as the semiconductor upcycle will lend support to economic growth, and emerging markets will be the one driving this growth. The stabilization in China's economy will be crucial for neighboring economies integrated in the regional supply chain, and such examples are most Southeast Asian economies, Japan, Taiwan, as well as South Korea. For equities, broadly speaking, we see more tailwinds, especially from policy support, while the largest headwind remains to be the US-Sino trade dispute. We see greater opportunities in emerging markets as they possess a favorable growth outlook and a robust earnings growth. Also, political risk, a key headwind for emerging markets in 2018, has largely faded as the election cycles in many different emerging markets have ended. So with that said, emerging markets still remains highly vulnerable to the risk of further trade escalation. We still favor Asia as many markets remain undervalued while supported by robust earnings growth. Aside from its solid fundamentals, we believe that the long-term story is still intact, and with the recent sell-off, the upside potential remains attractive. For fixed income, the general attractiveness has fallen after the dovish tilt in global monetary policy. Yields have fallen, and we expect spreads to remain compressed. The current spread levels no longer reflect an appropriate reward for the risk taken. Given current risk levels, deteriorating fundamentals, and the late business and credit cycle, this translates to greater risk of defaults. Overall, we prefer Singapore-centric bonds, EM bonds, and Asian high-yield products while avoiding the US high-yield bond market.